Hello, welcome to the channel. I decided to show how I get my daily bias every day before entering in lower time frame and take the trade. So these three concepts are what I'm going to talk about and show how I use them. It's very easy and simple. So first of all, ranges. Ranges are the swings of the price. For example, this is a range and this is where it ends. This is another range and this is where it ends. It's the first thing I look at, and you can see order flow of the market by looking at the current range. Every range has its own target, and until the price reaches its target, my bias is towards that target. Every time frame has its own range which is related to other time frames. For example, these two ranges were in daily. Now this is the weekly chart. The weekly range came up and reached its objective here, and it would be time for it to do a retracement since it ended, right? So going back to the daily chart, this is when the daily bearish range started. So this example that I showed right now shows how the weekly range and the daily range are related, and when I expect the bullish daily range to end and when the bearish range starts, and also how the ranges change after it reaches its objective. So how I determine the objective of the daily range and where is the draw on liquidity. So this section is very important because this is where I show where is the draw on liquidity of a certain range and how I determine what's the direction of the next daily range, which is my daily bias. So my draw on liquidity on a certain daily range depends on the higher time frame ranges and when my range exceeds. Depending on where the range can possibly reach, I choose my objective for the range, and that's my draw on liquidity. So for example, for this bullish daily range, I go to the weekly chart, and the draw on liquidity of this weekly range is that by sub liquidity pool. So basically the price is near the objective of the weekly range. So I expect the daily range to reach this liquidity. So that's my daily range objective. There is also this order block here that's right above the draw on liquidity. If I want to see reversals, a weekly order block is probably where it would happen because it's higher time frame premium array. So back in the daily chart, the range ended after reaching that objective. It had retracement to discount and expanded up until the weekly order block and the range and the daily range ended again. But this time I don't expect a retracement back to discount of the daily range because the weekly range also ended. I expect a retracement back to discount in weekly range and not daily range. And since weekly is the higher time frame, until the weekly range reaches discount, the daily range will be bearish. So now my bias is bearish in daily. So back in the weekly chart, I put the Fibonacci, and under the equilibrium there is this BC. So that's the discount of this bullish weekly range, and it's also my draw on liquidity. Now back in daily chart, there is also this liquidity pool. So now until price reaches these objectives, I expect the daily ranges be bearish. So this is how I determine my draw on liquidity depending on the ranges of higher time frames and how much my current range can expand. When a range ends, it goes to discount or premium before its next range until it reaches its objective, right? So where is the discount and premium of a range? The premium or discount of a range depends on the market program of the price. Sometimes price is very bullish, so its retracements are not that deep in discount. So you can expect the retracement to 25% of the range. Sometimes it's not so bullish, and you can expect the price to have retracement back to equilibrium of the range. And sometimes the price is in a condition where it has retracement so deep in discount that you should look for your PDA and objectives under 75% of the range. And when it's in a consolidation, it's very simple. Under equilibrium is always discount, and above it is premium. Price moves in its levels until its expansion time again. So you should always keep all these types of ranges in your mind and identify what type of ranges you are trading, and you can easily identify what type of range you are trading by seeing what type of program you are in, what's the condition of the market, how bullish or bearish the price is. Price is fractal. Price moves the same way in all time frames, and all the time frames have their own ranges that are moving relatedly with other time frames ranges. So you should always see the ranges of all time frames and trade your own range aligned with other time frames ranges. Here is a live example of me trading with the concept I just told. So this is a half an hour range and price is very bullish, but it exceeded its range. So now I expect a retracement to discount before entering trade long, targeting liquidity above the price. So just like I said, I want to take a long, buy the price. But here I sold the price because just like I said, I also expect the half an hour range to have a retracement. So in 1 minute range, I'm bearish. So I sold the price, targeting the discount of the half an hour range. Also keep in mind that this retracement is happening at 9 a.m. New York session because time is very important. After price reached the half an hour discount, now this is time to enter long in half an hour range and targeting my main target, which is in buy side. As you can see, I entered long and price is respecting the discount in half an hour range. So you can also see the power tree happening in this trade because 9 a.m. had a retracement back to discount and it's close to 9.5 where price expanded up and almost reached my target. I took half of my position off here and I also took this trade with real money and my profit got hit. And here in paper trading, price reached my target. So now I took both of the trades after retracement and then the expansion of the half an hour range in different ranges and different time frames. Subscribe if you found this video helpful.